Hey, welcome back to Everything Money. Today we are talking about the Chinese company Alibaba. We will go through a fundamental analysis and look at the financials using our software, which you can get. We will show you what you should be paying for Baba moving forward and why we own it. We will also head over to Mo. He does the charts. If you're into trading Baba, he'll show you the trends and the charts, all this and more in this video. But first, why should you be watching us? I represent you. I bring your questions about Alibaba to two guys who own and operate over $100 million in real estate, multiple businesses and stocks, and we will talk about why we love Alibaba right now. I give you Paul Gabriel. Hey, Paul.
Thanks, Seth. So guys, remember, follow us on Instagram. We have a new Instagram account, and also follow us personally because our mothers constantly call us telling us, why aren't you more famous?
It's true. We have a long story with Alibaba, Paul.
We do. So Alibaba, as a quick recap to people who are new, Alibaba was a company I like the financials of, but I always questioned, are the financials legit because it's coming out of China and there are questions to Chinese data? But then I did something very rare. I copied someone, Charlie Munger. Now, I didn't copy Charlie Munger's valuation, and to be honest, I have no idea what he values Alibaba at. That's not the point, though. He trusts the numbers. If he trusts the numbers, I'm going to trust that. I'm not a big fan of copycatting and all that stuff. I believe in individual analysis, which we did do. But if he trusts the numbers, I trust the numbers.
We also loved how Manesh Pabrai loved this company, whom we are interviewing in December, so stay tuned for that. Keep going, Paul, on
Awesome.
Alibaba.
So Alibaba, I own a position. It's actually my largest individual holding, and I want to buy more of it as time goes on. So Alibaba has gone from 320 down to as low as 130. I don't even know where it's at. This just goes to show how much I don't care where stocks are at, guys. I have no idea where Alibaba is today, right? They just had Singles Day, which it's not. At first, I thought it was a day for a bunch of people to go find future mates.
What is it, Mo?
It's a day where you embrace being single and you go and buy stuff.
Oh.
Is that really what it is?
Yeah,
so it's
Singles
like America.
Day is an informal Chinese holiday celebrating being single was turned into an e-commerce event by Alibaba in 2009. They did $15.6 billion in sales between November 1st and November 11th.
Have you heard these whack numbers out of China, though, Paul? I've seen an article like there are 20 million there are 20 million Chinese men that literally do not have a spouse. There's not enough women for spouses for 20 million men in China because remember they weren't allowing.
Yeah, you weren't allowed more than one child.
It's crazy.
We could just have polygamy.
Yeah, there you go, Mo. Just like your house.
Yeah.
Go ahead, Paul.
All right, so guys, I like Alibaba. We'll go to the Everything Money software. So guys, we go to the 8 Pillars tool. We type in Baba. Okay, so guys, let's start from the beginning. $455 billion company. Make note, I still don't know the stock price. Our first pillar is the 5-year PE. We want to be under 22.5. It is 27.24. That's an X. But remember, faster growing companies should get a higher PE, should get a higher multiple. Because think about it. If two companies make the exact same amount of money, one can grow at 10% a year, one can grow at 2% a year. Which one should you pay more money for?
Of course.
Very obvious. And that's pretty clear. Pillar number 2, we want a 5-year return on invested capital over 9%. This one is 10%. That's a check mark. Return on invested capital is how well do they make money off the money invested within the business through debt and equity. So they do a pretty good job of doing that. Okay, no dividend. That's not a pillar, but we always like to look at it. And guys, look at how much their free cash flow is growing. Their 5-year average is $18 billion. Last year was 33.7. That's incredible. So pretty good stuff. So far, 1X and 1 check.
If you're new to the channel, what we do is we use our 8-pillar analysis to look at it's as an initial screener to see if we like a company. We'll dig deeper if we do. We have, but we'll keep going. Pillar number 3 is profit growth, revenue growth over the past 5 years, which are different. I always get confused.
Yes. So I go to the income statement on our software. Scroll down a little bit, 27.6 billion to 120 billion last year. That's massive growth, guys.
I almost
so
spit
again,
out my coffee, Paul.
Fast-growing company, did 1.7 billion 8-9 years ago. Now it does 120. You should pay a premium for faster-growing companies. So for all of you haters out there who say I don't understand growth, tell me that. I'm not going to say it. You're wrong. Okay. Pillar number 4 is net income growth. We want to see the profit growth of the last 5 years. So we take our
handy dandy.
Take our mouse that wasn't working, and we go down to, we scroll down a little bit, 7.95 to 23 billion. Yeah! Big jump right there. Over triple, almost triple.
You can get the software behind Paul, and we'll show you how by the end of the video. Go ahead.
Pillar number 5, shares outstanding. Now, guys, this is a silent killer for investors. They don't realize that if a company issues a ton of shares at the wrong time, They are diluting the investors, and your shares, you're still going to own the same number of shares, but now you're getting a smaller piece of the pie. So for example, if there's 100 shares outstanding, you own 10. You own 10% of the business. If they issue another 50 shares, you now still own 10 shares, but I have 150 now instead of 100. So it's diluting you. So a company can still have growth, but you won't see that growth if the amount of growth within the business doesn't surpass the amount of growth in the number of shares outstanding. So we scroll to the very bottom of the income statement, and we go from 2.54 to 2.72. That's an X. So they are increasing the shares outstanding. The good news is this growth is way, way lower than the growth in the net income and the revenue. So I'm okay with that right now. I'm not as concerned about that. 8 years ago, 2.2 billion, now 2.7. So it's about a 20% increase, a little over 20% increase number of shares. Luckily, the company's profit and revenue are up way more than that. Pillar number 6 has to do with debt. So what I always do is I go to the main page. Now, guys, why does debt matter? Debt matters because just like your personal life, a company with less debt will last a lot longer than a company with more debt if there's a recession. Everything's great and dandy when the world economy is growing, everybody's making tons of money. That's not what matters. What matters is how do companies do when times are tough, when recessions hit. So go back to our main page of our software, go to the 5-year average free cash flow, 18 billion. I multiply that by 5, okay? That is $90 billion. So what I wanna do here is I wanna go find out, I want the long-term liabilities to be under $90 billion. So I go to the top, hit the balance sheet, scroll down to the bottom. Now with, that's quarterly, that's good. $37 billion right here.
Wow.
Wonderful. So they have very low debt compared to the free cash flow. In fact, last year's free cash flow was $33 billion. They could essentially, if they mimic that again, they could pay it off in a year, 13 or 14 months, fully. 13 months. So that's great.
The big mamma jamma is pillar number 7. This is free cash flow growth, and we will use this free cash to translate into a market price we want to pay for Alibaba. Keep going, Paul.
So guys, free cash flow is cash from operations less your capital expenditures. You can use that to do one of 5 things. Buy back shares, pay dividends, make acquisitions, pay down debt, or reinvest back in the business, right? I like looking at free cash flow versus net income because net income has SEC rules, accounting rules, all these GAAP rules that can affect the today's price, today's net income, but free cash flow is much harder to manipulate. Is it still possible? Absolutely, but it is harder. So cash from operations, less your capital expenditures. Now your Uncle Paul, because he cares about you very deeply.
Yes.
He added this line. Did I just talk about myself in the third person?
You always do.
I don't always do that.
Your Uncle Paul.
Your Uncle Paul. I meant like he, when I said he, I don't mind the Uncle Paul part. The he part, that's a little arrogant.
Because I forgot your pronouns are they, them, so keep going.
So I added this line to the free cash flow statement, to the cash flow statement. That way it makes it easy for you. But again, there's more to this software. I'll show you where it does all the math for you so that we don't have to do all this stuff. But either way, 10 billion 5 years ago, 29 billion last year. That's
okay.
A check mark.
Yeah, that's okay.
Now our final thing, what we do is we have a starting point. Just like the 5-year PE, we want under 22.5. We want a price to free cash flow under 20. So we take the 18.36 5-year average, multiply it by 20, $366 billion.
Oh, wow. The market cap is 454, Paul.
Okay, so that's an X. But guys, remember, this is a fast-growing company. I don't think 20 is a reasonable multiple, but it's part of our 8 pillars. So we have to stick to the 8 pillars, but our job on this channel is to go, now let's look at the 8 pillars tab here at the top. Does all the math for you, right? Our biggest ones are the valuations. I'm not worried about them. Because I look at it going, this company is growing so fast. Why would I want to pay a small PE for a company that's growing fast? And the next thing we're going to do after all this is we're going to go to our stock analyzer tool. We'll be able to input our assumptions into the growth, and it'll tell us what price we should pay for the stock. Now, we created all of this because our users sat there and said, hey, I want to be able to analyze my stocks without waiting for your videos. And there's 10,000 stocks out there. You will not cover all those. So we created the software. You get it, mobile phone. You get all of this in your mobile app. You get all of this on here. You get everything on the main page that's coming out as well. There's all this extra content. All this extra stuff's coming, these tools. You get exclusive daily content from Seth Moe and I. You get access to Seth Moe and I. You get 30 years of financial data. We're adding data all the time. And most of all, We have over 6,000 people who subscribe to the software, and you can go into a very organized chat with them and discuss all your investment ideas, because most people are alone out there. They feel alone, and it allows you to go talk to people. That way you don't have to sit there and just listen to your family and friends telling you how crazy you are because you believe in cash flow. So sign up, only 90 cents per day. Sign up now at everythingmoney.com or Patreon, 90 cents a day. If you could just make 1 or 2% more in your money over long periods of time, this could add hundreds of thousands, if not millions, to your bank account for 90 cents a day. Everythingmoney.com. The benefit of going there is you only get charged in the first month. You don't get double charged, and you don't get charged a sales tax yet because we're not big enough. So 90 cents a day, no brainer. Go do this. Let's go to the stock analyzer tool.
Yeah, the final piece of the puzzle is, once say you like the 8 pillars of a company, what should you pay for this? You know, people say, oh, well, a stock is really high. Tesla's 1,000, or you have penny stocks and anywhere in between. So we want to translate this into appropriate price for this company.
Correct. So first things first, years of analysis. On companies that are growing fast and will be around for a long time, which I think Alibaba will be, I go to 10 years. Number of assumptions, let's go with 3 because it's a fast-growing company. Let's put some assumptions in here. Then it gives us our 1, 5, and 10-year data. Obviously, it doesn't have 10-year data because they only went public back in 2013. So, guys, my job is to be conservative, right? Mo, what would you give me for some revenue growth assumptions for
I want to
Alibaba
know it,
in
because
being
how
conservative?
long can they keep this up, this 40%
Yeah,
growth?
I just, let's put it this way.
I'd probably go 20, 25, 30 because
Okay.
they still have
For 10 years? 10 years, Mo?
Yeah, I mean, I do think that
So
they can keep that
1.3,
up.
30% for 10 years
I like when you do this.
would take their revenue to $1.6 trillion in 10 years.
Current
What's their current
revenue?
120 billion.
Billion.
So it'd be 13 times larger.
It's a lot, but also I'm going high side 30%.
Yeah, high side.
Put
So
20%.
So my thing is, my personal opinion is, I'm doing 10, 15, 20. Because I still want to be conservative at 20% revenue growth.
Yeah, do 20%.
Because right now, the biggest company in the world does like 500 billion. That would be over triple the biggest company in the world right now. So at 20% over 10 years, that would be a $740 billion revenue. Okay, much more reasonable.
It's
in my
more
opinion.
reasonable, and that's actually practical. Go and look at it. Well,
I know where you're going with this. I just wanted to ask this. So you say like the biggest company in the world only does X amount, but what about 10 years ago? Apple was still a Goliath. Like,
Well,
the words out of my
Walmart
mouth.
was doing 400 billion 10 years ago.
oh, okay. And they're doing what today? So
500 billion.
Oh, it's only.
So I want
oh.
you. I was going to say go look at Amazon because it's a very comparable business.
Yeah, but the
See what
bigger
they're
and
doing.
bigger it gets.
Right, but go back 10, 15 years ago and see what they did.
Oh, 10 years ago? Yeah, it's way lower
Just
than it
because I
is
want to see
today.
the projection moving out to see what we can project for them.
Correct, but the bigger and bigger the company gets,
the
the harder
slower
it is.
it- yeah,
So to
exactly.
get 30% growth for 10 years, that's essentially meaning like 50, 60% a year for the first couple years,
Yeah.
then slowly going
I
down.
see. Okay.
So again, I could be wrong, but my job as an investor is to be conservative. So I want to buy companies at prices lower than even my conservative estimates. That's what Warren Buffett and Charlie Munger like to do. That's what every value investor likes to do. Let me pick conservative assumptions for a company, and if it's still selling for cheaper, let me figure out if it's the right analysis or not. So 10, 15, 20. Now profit margin. Let's go 17, 19, 17, 20, and 23. Free cash flow margin. Let's do the same thing. PE. Bigger companies, it's going to be a lower PE because the only time you pay a high PE is when there's a lot of growth potential. So the bigger and bigger this company gets, the harder it is. So 10 years from now, it's going to be a huge company. You got to pay a reasonable PE.
If you're at home watching, you also have to recognize, if you're new to this, that we're in the most overpriced and bullish market in the past 10 years. Life
No,
is,
in our life, probably in our lifetime.
yeah, so it's not going to be like this, like what you're seeing in the past few years. Why it could be very dreadful next 12 years. So keep that in mind, and taking into account some of these assumptions.
So I finally looked at the stock price, guys. I hit the analyze button. The stock is currently at 167. I did 12.5% return on my desired return. Why? Because you can get 10%, 9 or 10% by doing an ETF. So if you want to go buy an individual stock, make it worth your while. Put that margin of safety in there for you. That's part of the margin of safety. I hit the analyze button. I have exorcised the demons. This house is clear. Yeah! Name that movie in the comments, thanks. So guys, I have a middle range of 260. Heck, I have a low range of 149. The stock's at 167. It was selling for 138 just a few weeks ago. I have a high. If we're able to do the 20% revenue, which I don't think is unreasonable, I'd be willing to pay $450 for the stock today.
Because you think in next 10 years it could get well over $1,000. I mean,
And by the way, at 450, 12.5% return, 1.125 to the 10th times 450, that makes the stock a $1,500 stock in 10 years.
Doesn't seem absurd.
That's a 10x. That's a 10 bagger right there from here today. Is that going to happen for sure? I don't know, but I look at it going, I still think it's going to do very, very well over the next 10 years.
If you're looking to trade Alibaba at a quicker pace, this is one of the most requested stocks we've ever had in our show, and Mo can help you. He shows you the trends, the charts every day in that Bid-Ask Nation. Mo, what's going? Oh, look at that sweet spot, baby.
This is my daily. This is my second time reviewing this today because we did it on the morning show. It's the daily hub.
The hourly Baba update.
Exactly. So 167 it's at right now. The next resistance point is somewhere around this 150 area, and then below that 140. And you'll remember they dropped to like 139. And then they came right back up because that low end of 140 was really their support level where they could hold that level very well. So what would I do? Guys, long term for Alibaba, it's not something that I want to get into right now. And the reason is there's just too much craziness going on. When everything kind of calms down a little bit more and they get a smooth stochastic growing to the top, that's when I'll go for it. But for right now, I would jump over here on a daily chart. Look at it moving through the sweet spot right now. If you get any type of engulfing candlestick, run this up to the 100-day moving average at 179, 200-day moving average at 205, and this is the best way to play this right now, in my opinion. You can day trade it on a 15-minute chart, or you can swing trade it over here. I would not look at this for a long-term play right now because that volatility is way too much right now. So you can make money on this. Just take it easy. So.
My son owns Baba. I own Baba, Paul. We were buying Baba when it was at 200, and when it went down to 130, we got a lot of complaints. But your thoughts on Alibaba moving forward?
I love it when it goes down. I sell puts at lower levels, and I want to accumulate more shares as it goes lower.
That's our take. We will update you. One of our favorite companies, and one of my biggest holdings as well, Paul. I just love this company. My son loves it. I think he's getting some Baba stock for Christmas from my mother.
Wow.
Yeah, things are progressing.
Financial planner.
Yeah, that's our take. Fondle a thumbs up. Join the community. We'll talk about this stock and join us next video. Thanks for watching.